Before we begin, it is critical to understand that the information presented in this video is for educational and informational purposes only. I am not a financial advisor, mortgage broker, or real estate agent. The home loan process involves significant financial decisions with long-term consequences. You should always consult with qualified and licensed professionals, such as a financial advisor, a mortgage loan officer, and a real estate attorney, to get advice tailored to your specific situation. This presentation is not a substitute for professional advice and should not be used as the sole basis for making financial decisions. You found it. The one. The house with the perfect kitchen island, the backyard that's just begging for a barbecue, the extra room that would make the perfect home office. You can already see yourself living there. You pull up the listing on your phone for the 10th time today, your heart thumping with excitement. But then a cold wave of dread washes over you. The price, the down payment, the mortgage. Words like pre-approval, escrow, and PMI start swirling in your head like a swarm of angry bees. Suddenly, your American dream feels like an American nightmare, a complex, terrifying puzzle designed to keep you out. If that feeling is even remotely familiar, I want you to take a deep breath. You are in exactly the right place. Because the secret the multi-trillion-dollar mortgage industry doesn't want you to know is that this process isn't actually that complicated. It's just intentionally confusing. It's filled with jargon and gatekeepers to make you feel small, to make you feel like you need them to translate a foreign language. But that ends today. Over the next 10 parts, we are going to dismantle the entire U.S. home loan process piece by piece. We're not just going to scratch the surface, we are going deep. I'm going to give you a step-by-step, no-fluff, battle-tested playbook that will transform you from a nervous first-time buyer into a confident, educated, and empowered homeowner. This isn't just about getting a loan. It's about getting the right loan. It's about saving you tens of thousands of dollars over the life of your mortgage, eliminating 90% of the stress, and giving you the power to negotiate from a position of strength, not desperation. We are going to turn that confusion into clarity, and that fear into confidence. So let's start at the only place that matters, the beginning. Step 1 isn't filling out a form or calling a bank. Step 1 is a financial health check and a critical mindset shift. This is the foundation upon which your entire home buying journey will be built. If you get this part right, everything else becomes 10 times easier. If you skip it, you're setting yourself up for failure, frustration, and costly mistakes. First, the mindset shift. You have to stop thinking like a renter and start thinking like an owner. A renter's biggest financial decision each month is paying rent. An owner's biggest financial decision is managing the single largest asset and liability they will likely ever have. This isn't just about buying 4 walls and a roof. It's about making a massive investment in your future. It requires a level of seriousness and due diligence that you've probably never applied to anything else in your life. Embrace that. This is your future and you are in control. With that mindset in place, we move to the practical part, your financial health check. We need to look at your finances through the cold, hard eyes of a lender. Lenders care about one thing above all else: risk. They are asking themselves one simple question. If I lend this person hundreds of thousands of dollars, what is the probability I will get my money back? Your job is to make their answer a resounding very, very high. And you do that by getting 3 core numbers in order. The first, and arguably the most important number in your entire adult life, is your credit score. Think of your credit score as your financial report card. It's a 3-digit number, typically between 300 and 850, that tells lenders how responsibly you handle debt. A higher score means you're a lower risk, and a lower risk means you get a better interest rate. And let me be crystal clear. The interest rate is everything. Let's run a quick, jaw-dropping example. Say you're buying a $400,000 house. If you have an excellent credit score, you might get an interest rate of 6.5%. If your score is just okay, you might get a rate of 7%. A 0.5% difference. Seems small, right? Wrong. That 0.5% difference on a 30-year mortgage for $400,000 will cost you over $53,000 in extra interest payments. $53,000. That's a new car. That's a college fund. That is the cost of not taking your credit score seriously. Before you even think about looking at houses on Zillow, you need to know your credit score. You can get it for free from all 3 major bureaus, Equifax, Experian, and TransUnion, at annualcreditreport.com. Look at it, study it, and if it's not above 740, your first mission is to work on improving it by paying bills on time, lowering credit card balances, and disputing any errors. The second critical number is your debt-to-income ratio, or DTI. This sounds like complicated bank jargon, but it's incredibly simple. It's the percentage of your gross monthly income. That's your income before taxes. That goes toward paying your monthly debts. Lenders use this to gauge whether you can truly afford the new mortgage payment on top of your existing financial obligations. Here's the formula. Total monthly debt payments divided by gross monthly income. For example, let's say you make $6,000 a month before taxes, and your monthly debts, car payment, student loans, credit card minimums, add up to $1,500. Your DTI is $1,500 divided by $6,000, which equals 0.25, or 25%. Lenders look at two types of DTI. The front-end ratio is just your potential new housing payment. The back-end ratio, which is the more important one, includes your housing payment plus all your other debts. Generally, for a conventional loan, lenders want to see a back-end DTI of 43% or less, though some programs allow for up to 50%. Knowing your DTI right now tells you how much room you have in your budget for a mortgage payment. It is your financial reality check. The third and final piece of your financial health check is your savings. We're talking about cash on hand for two major things: your down payment and your closing costs. First, let's bust the biggest myth in real estate. You do not always need 20% down. That is a myth that keeps millions of people renting. While a 20% down payment on a conventional loan allows you to avoid private mortgage insurance, or PMI, many loan programs require far less. FHA loans can go as low as 3.5% down. Some conventional loan programs allow for 3% or 5% down. And if you're a veteran or active duty military, a VA loan might allow you to put 0% down. But the down payment is only part of the story. You also need cash for closing costs. These are the fees for services required to close the loan, things like the appraisal fee, title insurance, and loan origination fees. A good rule of thumb is to budget between 2% and 5% of the home's purchase price for closing costs. On that same $400,000 house, that's an extra $8,000 to $20,000 you need in cash on top of your down payment. And on top of that, lenders want to see that you have cash reserves left over after you close, typically enough to cover 2 to 6 months of your new mortgage payment. This proves to them that if you lose your job, you won't immediately default on the loan. So let's recap step 1. You've shifted your mindset to that of a serious investor. You've pulled your credit report and know your score. You've calculated your debt-to-income ratio to understand what you can realistically afford. And you've taken a hard look at your savings to see what you have for a down payment, closing costs, and reserves. This is the unsexy, unglamorous work that no one posts on Instagram, but it is the single most important step in the entire process. Doing this work up front puts you in the driver's seat. You're no longer guessing. You're operating from a position of data-driven confidence. Now that you've done a full diagnostic on your financial health, and you know exactly where you stand, you are ready to take the next step. You're ready to start assembling the evidence to prove to a lender that you are a fantastic, low-risk borrower. This is where we gather your paperwork. And in the next part, I'm going to give you the ultimate document checklist, the exact list of pay stubs, tax returns, and bank statements you need to have ready. Having this package prepared before you ever speak to a loan officer will make you their absolute favorite client, and will put you light years ahead of 99% of other homebuyers in the market. So now picture this. You've got your digital folder, your financial life neatly organized. You're not just prepared, you're a professional. This is the moment you transform from a dreamer into a serious contender. This is where you get your pre-approval. And let me be crystal clear. A pre-approval is not the same as a pre-qualification. Not even close. A pre-qualification is a 10-minute phone call where you tell a lender your income, they ask about your debt, and they give you a ballpark number. It's a guess. It's a marketing tool. It's worth less than the paper it's printed on when you're making a real offer. A pre-approval, on the other hand, is the real deal. It's a conditional commitment from a lender to give you a mortgage up to a certain amount. It means they've pulled your credit, they've seen your pay stubs, they've verified your bank statements, they've looked under the hood of your financial engine and said, yes, this machine can handle the loan. Getting pre-approved is the single most important step you can take before you even think about looking at houses. Why? Because it does 3 critical things. First, it tells you exactly how much house you can actually afford. Not what a website calculator thinks, but what a bank is willing to physically lend you. This saves you from the soul-crushing heartbreak of falling in love with a home you can't have. Second, it makes you a powerful buyer. When you submit an offer with a pre-approval letter attached, you're telling the seller, "I'm serious, I'm vetted, and I can close this deal." In a competitive market, offers without a pre-approval letter are often thrown straight into the trash. And third, it dramatically speeds up the closing process later, because most of the heavy lifting on the financial side is already done. So, where do you get this golden ticket? You go to a lender. But not just any lender. You need to shop around. This is one of the biggest financial decisions of your life, and the lender you choose can save you, or cost you, tens of thousands of dollars over the life of your loan. You essentially have three main choices. First, you have your big retail banks. Think Chase, Bank of America, Wells Fargo. The pros? You might already have a relationship with them, and they're stable, established institutions. The cons? They can sometimes be slower, more bureaucratic, and may not always offer the most competitive rates unless you're a high-net-worth client. Second, you have credit unions. These are nonprofit, member-owned institutions. The pros here are often fantastic customer service and sometimes really competitive rates, especially if you're already a member. The con is that their technology might not be as slick, and their loan product options might be more limited. Third, and in my opinion a fantastic option for many first-time buyers, is a mortgage broker. A broker doesn't work for one single bank. Instead, they work with dozens of different wholesale lenders. Think of them like a travel agent for home loans. You tell them your situation, and they shop around on your behalf to find the best loan product and rate from a wide variety of sources, many of which you've never even heard of. They can be incredibly valuable if your financial situation is a little unique. My advice? Talk to at least 3 different lenders, one from each category if you can. A bank, a credit union, and a mortgage broker. Don't worry about it hurting your credit score. The credit bureaus understand that people shop for mortgages. As long as all the credit inquiries from mortgage lenders happen within a 14 to 45-day window, they count it as a single inquiry on your FICO score. When you contact these lenders, you'll say, "I'd like to get pre-approved for a home loan." And because you followed the advice from the last part, when they say, "Great, I'll need you to send over your last 2 pay stubs, 2 months of bank statements," you can say, "Already done. It's in your inbox." The loan officer on the other end of the phone will hear angels sing. You've just made their job 1,000 times easier and shown them you're a serious, organized client. Now, the lender is going to put your application through what's called underwriting. This is the official review process. They are essentially analyzing the risk of lending you hundreds of thousands of dollars. And they do this by looking at what I call the 4 C's of lending. The first C is credit. This is your credit report and your FICO score. They're looking at your history of paying bills on time. Do you have a track record of responsibly managing debt? They'll look at credit card balances, car loans, student loans. A higher credit score generally gets you a lower interest rate, which can save you a fortune. Most conventional loans are looking for a score of 620 or higher, but the best rates are usually reserved for scores above 740. The second C is capacity. This is your ability to repay the loan. The key metric here is your debt-to-income ratio, or DTI. It's one of the most important numbers in the entire process. Your DTI is all your monthly debt payments, things like your car payment, student loans, credit card minimums, plus your new estimated mortgage payment, divided by your gross monthly income before taxes. For example, if your new mortgage is $2,000, your car payment is $400, and your student loans are $300, your total monthly debt is $2,700. If you make $6,000 a month before taxes, your DTI is 45%. Most lenders want to see that number below 43%, though some government-backed programs allow for a little higher. This is the lender's way of making sure you won't be house poor, with every last dollar going to your mortgage payment. The third C is capital. This is your cash, your assets, the money you have saved for a down payment and closing costs. Lenders need to see that you have the funds to close the deal. And they don't just want to see the money, they want to see where it came from. They will scrutinize your bank statements. A large random deposit of $10,000 from a month ago will raise a huge red flag. Is it a loan from a family member that you have to pay back? Is it undisclosed income? This is why it's so important to have your money sitting in your account for at least 2 to 3 months before you apply. If you're getting a gift from family for the down payment, that's perfectly fine, but it needs to be documented with a formal gift letter, which the lender will provide. They just need to verify it's a true gift, not a loan in disguise. And the fourth C is collateral. This one comes a little later in the process, but the pre-approval is based on it. The collateral is the house itself. The lender is making sure that the property you want to buy is actually worth the price you're paying for it. They do this through an appraisal. If you default on your loan and they have to foreclose, they need to know they can sell the house and get their money back. Your pre-approval is essentially saying, we will lend you up to X amount of dollars, provided you find a house that is worth it. So the lender takes your documents, pulls your credit, calculates your DTI, verifies your assets, and runs it all through their system. Within a day or two, sometimes even just a few hours, they'll come back to you. They'll tell you the maximum loan amount you're approved for, the types of loan programs you qualify for, and they will issue you that all-important pre-approval letter. This letter is your sword and shield. It's your official entry ticket into the world of serious home shopping. It makes you a legitimate player in the eyes of real estate agents and sellers. You are no longer just browsing Zillow on your lunch break. You are a qualified buyer with the financial backing to make a life-changing purchase. You now know your exact budget, you have proof of your buying power, and you are ready for the fun part to begin. And that's exactly where we're going next. With this pre-approval letter in your hand, it's time to assemble the rest of your team. It's time to find a rockstar real estate agent who will fight for you, find you the right home, and guide you through the maze of making an offer. Now, a lot of people think a real estate agent is just someone with a key card who unlocks doors for you. That's like saying a surgeon is just someone who knows how to hold a scalpel. The truth is, the agent you choose can single-handedly make or break this entire experience. They are your guide, your negotiator, your strategist, and your advocate. A great agent is the difference between finding a hidden gem and overpaying for a money pit. A bad agent? Well, a bad agent can turn your dream of homeownership into a full-blown nightmare. So, how do you find this superstar? First, you need to understand a critical concept: a buyer's agent versus a seller's agent. When you see a house for sale, the agent listed on the sign, the listing agent, works for the seller. Their legal and ethical duty, their fiduciary responsibility, is to get the highest possible price and the best terms for the person selling the house. Not for you. You need your own agent, a buyer's agent, whose fiduciary duty is to you. They are legally bound to represent your best interests, to get you the lowest possible price and the best terms. Never, ever work directly with the seller's agent to buy a home. It's like going into a legal battle and asking the other guy's lawyer for advice. Just doesn't make sense. Okay, so where do you find your champion? The single best place to start is with referrals. Ask your friends, family, and coworkers who they used and, more importantly, why they loved them. Don't just ask, who's your agent? Ask, how did they handle it when the inspection found a problem? How were they at communicating? Did you feel like they were really fighting for you during negotiations? A glowing personal recommendation is worth its weight in gold because it comes with a story of success. Your lender is also a fantastic resource. They work with agents every single day, and they know who is professional, who closes deals on time, and who causes problems. If you don't have personal referrals, you can turn to the internet, but you have to be smart about it. Websites like Zillow, Realtor.com, and even Yelp have massive directories of agents with client reviews. But read these reviews with a critical eye. Look for patterns. If you see multiple reviews that say, "This agent was an amazing communicator," or "She really understood the local market and got us a great deal," that's a strong signal. Be wary of agents with only a handful of perfect 5-star reviews from years ago. You want someone who is active and successful now. Once you have a short list of 3 to 4 potential agents, it's time for the most important step: the interview. Yes, you are interviewing them for a job. This is likely the biggest financial transaction of your life, and you are the CEO of this purchase. You need to hire the best person for your team. Call them up and say you're a first-time homebuyer with a pre-approval letter in hand, and you'd like to schedule a 15 to 20-minute chat to see if you're a good fit. A great agent will be thrilled to do this. If they act like you're wasting their time, that's your first red flag. Hang up and cross them off the list. So, what do you ask in this interview? Here are the non-negotiable questions. First, how long have you been a full-time real estate agent? And how well do you know the specific neighborhoods I'm interested in? You don't want a part-timer who does this on weekends. You need a dedicated professional. And local expertise is everything. A great agent knows which streets have drainage issues, which school districts are overrated, and which neighborhoods are about to see a huge jump in value. They have on-the-ground intelligence you can't find online. Second, How many buyers have you successfully helped close on a home in the past 12 months? This isn't about being nosy. It's about gauging their current experience and success rate. An agent who has closed 15 or 20 buyer-side deals in the last year is in the trenches. They know the current market dynamics, what offers are winning, and how to navigate the latest challenges. Third, and this one is huge, what is your preferred method of communication, and what can I expect for your response time? This question sets expectations from day one. If you're someone who needs quick text message updates, and they're an agent who only checks email twice a day, it's going to be a frustrating relationship. A good agent will tell you something like, I'm available by text, email, or phone. During business hours, I'll get back to you within an hour. For urgent matters in the evening or on weekends, you can always call me. This shows professionalism and a commitment to service. Fourth, in a competitive market like this, what is your strategy for helping my offer stand out? Listen carefully to their answer. A rookie agent might just say, oh, we'll offer more money. A seasoned pro will talk about a multifaceted strategy. They'll mention things like writing a personal letter to the seller, using an escalation clause, offering a flexible closing date, or having a strong relationship with the listing agent. Their answer will reveal their depth of knowledge and their creativity as a negotiator. And finally ask, can you provide me with the names and contact information for 2 or 3 of your most recent buyer clients? The best agents will have a list of happy clients ready to sing their praises. If they hesitate or make excuses, that's a major red flag. Speaking of red flags, be on the lookout for them. An agent who immediately starts pushing you to look at homes above your pre-approved budget is not working for you. They're working for a bigger commission check. An agent who agrees with every single thing you say and never offers a counter opinion or expert advice isn't an expert. They're a people pleaser, and that won't help you in a tough negotiation. And an agent who is disorganized, shows up late, or seems distracted during your initial conversation will likely be that way throughout the entire process. Trust your gut. If it feels off, it probably is. Once you've found the one, your rockstar agent, you'll typically sign a buyer-broker agreement. Don't be intimidated by this document. It's a standard contract that formalizes your relationship. It outlines the agent's duties to you, your duties to them, the length of the agreement, and how the agent gets paid. And let's talk about that for a second. In the vast majority of transactions in the United States, the buyer's agent's commission is paid by the seller from the proceeds of the sale. So, you get this expert representation and guidance essentially for free. The agreement simply ensures that if you buy a house in that area during that time, that agent is the one who represents you and gets paid for their work. With your agent chosen and your agreement signed, the real fun begins. This is where your dream starts to take shape. Your agent will sit down with you and have a deep conversation about your wants and needs. Not just the number of bedrooms and bathrooms, but your lifestyle. Do you need a home office? A backyard for a dog? Do you want to be in a walkable neighborhood with coffee shops? Or do you prefer quiet and privacy? Based on this, they will set you up with a customized search on the Multiple Listing Service, or MLS. This is the official real-time database that all agents use. It's far more accurate and up-to-date than the public websites. New listings that match your criteria will be emailed to you the moment they hit the market. Now you start scrolling. You'll send your agent a list of homes you're excited about, and they'll start booking showings. When you walk through these houses, your agent's role is critical. You might be falling in love with the beautiful new kitchen, but your agent is the one in the basement looking for water stains. You're picturing where your couch will go, while they're pointing out that the roof looks like it's nearing the end of its life or that the windows are old single-pane glass. They are your objective eyes and ears, protecting you from your own emotions. You'll likely see a few duds. You might see a house that looked perfect online but has a weird smell in person. You might see one you love, only to find out it's right next to a noisy highway. This is all part of the process. Don't get discouraged. Every house you see helps you refine what you truly want. And then it happens. You walk into a home. The light hits just right. You can see yourself cooking in the kitchen, relaxing in the living room. Feels right. Your heart starts beating a little faster. You look at your agent and they see it in your eyes. This is it. This is the one. But in a flash, reality sets in. In this market, you know you're not the only one who just fell in love with this house. There are probably 5, maybe 10 other buyers thinking the exact same thing. Suddenly, the excitement is mixed with a surge of anxiety. Finding the house was the easy part. How in the world do you actually win it? How do you craft an offer that a seller can't possibly refuse? The answer isn't just about throwing more money at the problem. It's about building a fortress, an offer so clean, so secure, and so compelling that the seller sees it as the safest and best path to their own goal, selling their home. This is where your real estate agent transforms from a tour guide into a grandmaster strategist. You're not just filling out a form. You are crafting a legal and financial weapon. Let's break down this weapon piece by piece. The official document is called a residential purchase agreement, and it has several key components that can make or break your chances. First, and most obviously, is the offer price. This is the big number everyone focuses on. But how do you pick it? Your agent will pull what are called comps, or comparable sales. They'll look at recently sold homes in that exact neighborhood that are similar in size, condition, and features. This isn't just a Zillow estimate. It's a deep dive analysis. Are prices trending up or down? Did that house down the street sell for 10% over asking last week? This data gives you a baseline. In a seller's market, offering the list price is often just the opening bid. You have to think like the seller. They're likely looking at multiple offers. An offer that's $10,000, $20,000, or even $50,000 over asking price isn't just about getting more money. It's a signal of your seriousness. It screams, "We want this house and we are not here to play games." But the price is only the tip of the iceberg. The real strategy lies in the terms of the offer, specifically the contingencies. Think of contingencies as safety hatches. They are clauses in the contract that allow you to back out of the deal without losing your deposit if certain conditions aren't met. There are three major ones. The first is the inspection contingency. This is your single most important protection against buying a money pit. This clause gives you a set period of time, usually 7 to 14 days, to hire a professional home inspector to go through the house with a fine-tooth comb. They'll climb on the roof, crawl through the attic, test the plumbing, check the electrical panel, and examine the foundation. They are looking for everything from a leaky faucet to a cracked foundation. Their final report, often 100 pages long with photos, will be your roadmap to the home's true condition. If the inspection reveals major problems, say, the furnace is on its last legs or there's evidence of termite damage, the inspection contingency gives you leverage. You can go back to the seller and negotiate. You can ask them to fix the issues, or you can ask for a credit to cover the cost of repairs. And if the problems are too big, too scary, or the seller refuses to budge, this contingency is your eject button. You can walk away from the deal and you get your deposit back. Without it, you're buying the house as is, problems and all. Next up is the appraisal contingency. This one protects both you and your lender. Remember that pre-approval letter? The bank has tentatively agreed to give you a loan, but they have one massive condition. The house must be worth the price you're paying for it. So they hire an independent, third-party appraiser to determine the home's fair market value. The appraiser analyzes comps, inspects the property, and provides an official valuation. If you offer $600,000 for a house, and the appraiser says it's only worth $580,000, you have an appraisal gap. The bank will only lend you money based on the appraised value, the $580,000. That means you are suddenly responsible for coming up with an extra $20,000 in cash to cover that gap. The appraisal contingency allows you to back out of the deal if the appraisal comes in low, and you can't or don't want to cover the difference. It prevents you from overpaying and protects the bank from making a bad investment. The third major safety net is the financing contingency, also called a mortgage contingency. This is the ultimate backstop. Your pre-approval is a very strong indication you'll get the loan, but it's not a 100% guarantee. The underwriter could find something unexpected in your final review, or you could lose your job a week before closing. Life happens. The financing contingency states that if, for any reason, your loan falls through within a certain time frame, you can cancel the contract and get your deposit back. Without this, if your financing collapses at the last minute, the seller could not only keep your deposit, but potentially even sue you for damages. It's a critical piece of protection. Now you might be thinking, great, I'll include all three contingencies and be perfectly safe. And you would be. But remember those 10 other buyers? In a hyper-competitive market, a safe offer can look like a weak offer to a seller. A seller's biggest fear is a deal that falls apart weeks after they accept it, forcing them to put the house back on the market. Every contingency you include is another potential exit ramp for you, and another potential point of failure for them. This is where the high-stakes poker game begins. To make their offers more attractive, some buyers will choose to waive contingencies. Waiving the inspection contingency means you're accepting the house in its as-is condition, no matter what horrors the inspector might find. Waiving the appraisal contingency means you're guaranteeing you'll pay the difference in cash if the appraisal comes in low. Waiving the financing contingency means you're betting everything that your loan will be approved, because if it's not, you lose your deposit. This is an incredibly risky strategy reserved for buyers with very deep pockets and a high tolerance for risk, but it's often what it takes to win in a bidding war. A seller looking at two identical offers on price will almost always choose the one with fewer contingencies, because it represents a faster, more certain path to the closing table. Alongside these terms, your offer will include your earnest money deposit, or EMD. This is the good faith deposit you make when you sign the contract to show you're a serious buyer. It's typically 1 to 3% of the purchase price. So on that $600,000 house, you might put down $6,000 to $18,000. This money doesn't go to the seller directly. It's held in a neutral third-party account called escrow. If the deal goes through, that money is applied to your down payment or closing costs. If you back out for a reason covered by one of your contingencies, you get it back. But if you simply change your mind or breach the contract, the seller gets to keep it. It's your skin in the game. Finally, there's one last, often overlooked, element: the personal letter. In a world of finance and contracts, a letter to the seller telling them who you are and why you love their home can be a powerful tiebreaker. Humanizes you. You're not just a number on a page. You're a young family who can already picture your kids playing in that backyard, or a couple who fell in love with the kitchen where they plan to host holiday dinners. It connects with the seller's emotional attachment to the home they've often lived in for years. So you and your agent sit down. You analyze the comps, you decide on a price, you debate the contingencies, you determine your earnest money, and you write that heartfelt letter. You package it all together, along with your pre-approval letter from the lender, into one powerful strategic document. Your agent clicks send. And now the hardest part of all begins: the waiting. You've laid your cards on the table. Is it enough? Will the seller see your offer as the fortress you tried to build? The silence can be deafening, and every minute feels like an hour as you wait for the phone to ring. And then it happens. The phone buzzes, shattering the silence. Your heart leaps into your throat. You see your agent's name on the screen, and for a split second you hesitate. This is it. The moment of truth. You answer, your voice a little shaky. Hello. And on the other end, you hear the words you've been dreaming of, the two words that change everything. They accepted. A tidal wave of relief, of pure, unfiltered joy washes over you. You did it. You actually did it. You want to shout from the rooftops, you want to dance in the street. All the stress, all the searching, all the financial gymnastics, it was all worth it. For this one perfect moment, you are on top of the world. Your offer, your carefully crafted plan was the one. The seller saw the value, they saw the strength of your position, and they said yes. The house is yours. Well, almost. But what if the call doesn't go that way? What if your agent says, okay, we have a response, but it's a counteroffer? Don't panic. This is not a no. In fact, a counteroffer is incredibly common. It's a maybe. It's the seller saying, I like what you're offering, but let's talk about the details. This is where the real negotiation begins. A counteroffer isn't a rejection. It's an invitation to a dance. The seller might come back with a higher price. They might ask for a different closing date that works better for their schedule. They might want you to waive a certain contingency, or they might reject a concession you asked for, like help with closing costs. Your first instinct might be frustration. You put your best foot forward and it wasn't enough? But take a breath. This is business. Your agent is your most valuable player here. They will dissect the counteroffer with you line by line. What are they asking for? Is it reasonable? Where do you have room to move, and where do you need to hold firm? Let's say you offered $500,000 and they counter at $510,000. Your agent will immediately pull up the comps again. Is $510,000 still a fair price for the neighborhood? Does the appraisal feel likely to support that number? Maybe you can meet them in the middle at $505,000. Or maybe you hold firm on price but offer to close a week earlier, which might be more valuable to a seller who needs to move quickly. Negotiation is a delicate art of give and take. You're not just trading dollars, you're trading terms. The goal is to find that sweet spot, that magical number and set of conditions where both you and the seller can walk away feeling like you won. You can go back and forth multiple times, a strategic volley of offers and counteroffers until you finally reach an agreement. And then there's the other call, the one nobody wants. The one where your agent's voice is a little softer, a little more somber. "I'm sorry," they say. "They went with another offer." Feels like a physical blow, a gut punch. You've already pictured your life in that house. You know where the sofa would go, which room would be the office. You've mentally painted the walls and planned the first backyard barbecue. And now, in a single sentence, it's all gone. It is absolutely devastating, and it's okay to feel that. It's okay to be angry, to be sad, to feel like you've wasted your time and emotional energy. But this is not the end of your story. It's a painful but necessary part of the process for so many buyers. Every offer you make, whether it's accepted or rejected, makes you smarter. You learn more about the market. You learn what you truly value in a home. You learn what your absolute limits are. A rejection is not a failure. It's a data point. It's the universe telling you, not this one. The right one is still out there. So you take a day, you mourn the house that wasn't, and then you get back up, dust yourself off, and start the hunt again, armed with more knowledge and more resilience than before. But let's go back to that happy path. Let's say your offer was accepted, or you've successfully navigated the counteroffers and have come to an agreement. Congratulations! The seller has signed the purchase agreement. You've signed it. It's official. You are now what's known as under contract, or in escrow. These are the magic words that trigger the next, and arguably most intense phase of the process. So what do they actually mean? Under contract is exactly what it sounds like. You and the seller have entered into a legally binding contract to transfer the ownership of the property, provided certain conditions are met. You can't just change your mind and walk away without consequences. This is real. In escrow is the mechanism that makes the contract work safely for everyone. Think of escrow as a neutral third-party referee. An escrow company, or sometimes a lawyer, is brought in to hold all the important documents and, most importantly, all the money involved in the transaction. They don't work for you and they don't work for the seller. Their only job is to follow the instructions laid out in the purchase agreement to the absolute letter. They make sure the seller doesn't run off with your money, and they make sure you don't get the keys to the house until you've paid for it. They're the trusted middleman protecting both sides. The very first thing you'll do once you're in escrow is deliver your earnest money deposit. This is also known as a good faith deposit. It's a sum of money you pay up front to show the seller you are serious, that you have skin in the game. The amount is negotiable, but it's typically 1 to 3% of the purchase price. So on that $500,000 house, you'd be writing a check for somewhere between $5,000 and $15,000. This isn't an extra fee. This money will be applied toward your down payment or closing costs at the end. But for now, it doesn't go to the seller. It goes directly to the escrow company, which holds it safely in that neutral account. Now, this is critical to understand. The earnest money is what you stand to lose if you back out of the deal for a reason that isn't covered by one of your contingencies. Remember those escape clauses we talked about? The inspection contingency, the appraisal contingency, the financing contingency? This is why they are so monumentally important. If the home inspection reveals a massive foundation crack and you decide to walk away, you get your earnest money back. If the home appraises for far less than you offered and you can't make up the difference, you get your earnest money back. If for some catastrophic reason your loan falls through at the last minute, you get your earnest money back. But if you simply wake up one morning and decide you don't like the color of the kitchen cabinets anymore and want to cancel the deal, you can kiss that earnest money goodbye. It will be released to the seller to compensate them for taking their home off the market for you. With the contract signed and your earnest money safely in escrow, the clock starts ticking. Loudly. The purchase agreement is a timeline. It has deadlines for everything, for the inspection, for the appraisal, for securing your final loan approval. Each step is a domino that has to fall at the right time to knock over the next one. And the very first, most important domino is your lender. Up until now, your lender has been operating on hypotheticals. They've looked at your pre-approval documents and said, yes, based on this information, we are confident we can lend you this much money. But now it's not hypothetical anymore. There is a specific house with a specific address for a specific price. You immediately send a copy of your fully executed purchase agreement to your loan officer. And in doing so, you are essentially hitting the giant green go button on your formal mortgage application. You have officially moved from pre-approval to the full underwriting process. You thought the paperwork was intense before? You thought the financial scrutiny was deep? You have no idea what's coming. You've just unlocked the next level of the game, and the difficulty is about to ramp up significantly. The real race against time has just begun. This is where the process splits into 3 separate, high-stakes paths, all running at the same time. Think of it like a mission with 3 critical objectives that all need to be completed before the final countdown to closing can begin. If any one of them fails, the entire mission is in jeopardy. These 3 paths are underwriting, the appraisal, and the title search. They are the gauntlet you must run to get to the finish line. Let's start with the big one, underwriting. Up until now, you've been dealing with your loan officer. They're your guide, your coach. They've helped you gather your documents and get pre-approved. But the loan officer doesn't actually make the final decision. That power belongs to the underwriter. The underwriter is the final boss. They are the judge, jury, and executioner of your loan file. Their job is not to be your friend. Their job is to protect the bank's money. They are a financial detective, and your loan application is their case file. They will go through every single page you submitted with a magnifying glass, looking for any inconsistency, any red flag, any reason to say no. They will re-verify everything. That job you have? They'll call your employer, sometimes just days before closing, to make sure you still work there and that your salary hasn't changed. Those bank statements you sent in? They'll scrutinize every large deposit. If you deposited a few $1,000s in cash from selling a car on Craigslist, you better have a bill of sale and a copy of the check. They call this sourcing funds. They need to know that every dollar you're using for this purchase is legitimate and not a secret, undisclosed loan from a relative that could affect your ability to repay the mortgage. Your credit? They're going to pull it again. It's called a credit refresh. This is why we tell you do not, under any circumstances, make any large purchases or open new lines of credit while you're in this process. Don't go finance a new set of living room furniture. Don't buy a new car. Don't even apply for a new credit card to get 10% off at a department store. A new inquiry or a new loan on your credit report right before closing is a massive red flag to an underwriter. It changes your entire financial picture, your debt-to-income ratio, and it can absolutely get your loan denied at the last minute. The underwriter's work culminates in something called conditional approval. This is a huge milestone. It means the underwriter has reviewed your file and has deemed you worthy of the loan on one condition, or more likely on a dozen conditions. You'll get a list of things they need before they'll give the final unconditional approval. This list might seem insane. They might ask for a letter of explanation for a credit inquiry from 2 years ago. They might ask for your most recent pay stub even if you just sent one last week. They might ask for a detailed explanation of a single transaction on your bank statement from 3 months ago. Your job here is not to question it. Your job is to comply and to do it fast. The underwriter asks for a document, you get it to them that same day. You have to become the most responsive person on the planet. This is where deals get delayed. A buyer takes 2 days to respond to a request, the loan officer takes a day to process it, and suddenly your closing date is at risk. For the next few weeks, checking your email and answering your phone becomes your new part-time job. While the underwriter is dissecting your financial life, the second path is unfolding simultaneously. The appraisal. The appraisal has nothing to do with you and everything to do with the house itself. The bank is about to lend you hundreds of thousands of dollars, and they need to be sure that the asset they're securing that loan against, the house, is actually worth the money. It's their insurance policy. If worst-case scenario you stop paying your mortgage and they have to foreclose, they need to know they can sell the house and get their money back. It's critical to understand that the appraisal is not the same as the home inspection. The inspection was for you to find out if the furnace is about to die or if the roof is leaking. The appraisal is for the bank. An independent, state-licensed appraiser will be ordered by your lender. They will visit the property, measure the square footage, note the number of bedrooms and bathrooms, assess the overall condition, and take a lot of photos. Then they do the real work. They find recent sales of similar homes in the immediate area. These are called comparables, or comps. They are looking for 3 or 4 houses that are almost identical to yours, same basic size, same number of beds and baths, same general condition, that have sold within the last 90 days. They then make adjustments. If your house has a brand new kitchen but the comparable house has a kitchen from 1985, they'll add value to your property. If a comp has a swimming pool and you don't, they'll subtract value. It's both an art and a science. Ultimately, they produce a detailed report with their final opinion of value. And everyone, you, the seller, the agents, the lender, holds their breath waiting for that number. If the house appraises at or above the purchase price, everyone breathes a massive sigh of relief. The deal moves forward. But what if it doesn't? What if you agreed to pay $400,000, but the appraiser says the house is only worth $385,000. This is called an appraisal gap, and it's a huge problem. The bank will only lend you money based on the appraised value, not the purchase price. So in this case, they will only lend you the percentage of $385,000 you were approved for. That $15,000 difference has to be made up. You have three options. The seller can agree to lower the price to the appraised value. You can come up with an extra $15,000 in cash out of your own pocket to cover the gap. Or most commonly, you and the seller negotiate and meet somewhere in the middle. If no agreement can be reached, the deal often falls apart. The appraisal is one of the biggest hurdles in the entire process. And that brings us to the third and final simultaneous path, the title search and title insurance. This is the historical investigation of the property. While the underwriter is investigating you and the appraiser is investigating the physical house, the title company is investigating the house's legal history. Their job is to make sure that the person selling you the house actually has the legal right to sell it, and that no one else has a claim to the property. You might think this is simple, but property records can be a messy, tangled web stretching back centuries. A title company dispatches researchers to dig through county records, tax archives, and legal filings. They are looking for ghosts in the property's past. Is there an unpaid tax bill from a previous owner? Is there a contractor who put a lien on the house years ago because they never got paid for a kitchen remodel? Is there a forgotten heir from a will 50 years ago who technically still owns a piece of the property? Does the neighbor's fence actually encroach 2 feet onto your new land? These issues, called clouds or defects on the title, must be resolved before you can close. The title company works to clear them. Once they determine the title is clear, they issue a title insurance policy. This is non-negotiable. Your lender will require you to buy a lender's title insurance policy, which protects their investment in the property. But there is also an owner's title insurance policy, which protects you. It is almost always optional, but you should absolutely 100% get it. It's a one-time fee paid at closing that protects you for as long as you own the home. If 5 years from now, that long-lost heir from a 50-year-old will suddenly shows up with a lawyer and a valid claim to your land, your owner's title insurance policy is what pays for the legal battle to defend your ownership. Without it, you're on your own. So let's recap. You're in a three-front war. The underwriter is tearing apart your finances. The appraiser is determining if the house is worth what you're paying. And the title company is digging for skeletons in the property's closet. All three of these investigations are happening at once. A frantic race against the calendar. Each one is a potential landmine that could delay, or even completely derail, your dream of owning this home. You're constantly checking your phone, waiting for that email from your loan officer, hoping for good news. And then one day an email does arrive. The subject line contains 3 little words that will make your heart leap. 3 words that signal the end of the uncertainty and the start of the final sprint. But getting those 3 words is the hardest part. And sometimes, just when you think you're safe, one of these 3 paths takes a dark turn, and your entire deal hangs by a thread. The first of these 3 paths is a journey into your financial past. It's your entire history of borrowing and repaying, every promise you've kept and every one you've broken, laid bare for a stranger to judge. This is the path of credit, and the gatekeeper is the underwriter. Now, you might picture the underwriter as some shadowy figure in a back office, stamping denied in big red letters just for fun. But that's not it at all. Think of them as the ultimate risk detective. The lender is about to hand you hundreds of thousands of dollars, and the underwriter's job is to make 100% sure you're a good bet. They are the last line of defense for the bank's money. When they look at your credit, they're not just glancing at the 3-digit number you've been obsessing over. That FICO score got you in the door, but now they're reading the novel. They're looking for the story behind the score. They'll scrutinize every account you have open. Do you have a long history of on-time payments? That's a fantastic sign of reliability. Or is there a pattern of late payments on a car loan from 3 years ago? They'll see it. They'll see that credit card you maxed out in college and the collection account from a utility bill you forgot about when you moved. Every detail matters. And this is where deals can suddenly take that dark turn. Let's say you've been pre-approved, you found the house, and your file goes to underwriting. But 2 weeks ago, excited about your new home, you went to a furniture store and opened a new line of credit to get 0% financing on a new sofa and bedroom set. To you, it was a smart financial move. To the underwriter, it's a 5-alarm fire. Why? First, the hard inquiry for that new car dings your credit score, potentially dropping it below the lender's minimum requirement. Second, you just took on new monthly debt. This changes your debt-to-income ratio, the very calculation your entire approval was based on. The loan that worked last week might not work today. Your dream now hangs in the balance because of a couch. This is why your loan officer tells you, begs you, not to make any major purchases, open new credit, or even change your cell phone plan while you're in the loan process. Don't breathe on your credit report. Just leave it alone. The second path the underwriter walks is an examination of your present. Your ability to handle the mortgage payment right here, right now. This is the path of capacity. It's all about your income and your assets. You've already submitted pay stubs, W-2s, and bank statements, but the underwriter treats these documents like a crime scene. They are looking for absolute, indisputable proof. They will verify your employment not once but often twice, once when they receive the file, and then again right before closing. They need to know you still have the job you claim to have. This path is littered with traps for the unprepared. The most common is the mystery of the large deposit. Let's say your parents, bless their hearts, gave you $20,000 to help with your down payment. You gratefully deposit the check. A week later, the underwriter sees this massive influx of cash in your account. To them, this isn't a gift. It's a giant red question mark. Is this a loan from a friend that you'll have to pay back? If so, that's an undisclosed debt that affects your DTI. Is it money you pulled from a cash-out refinance on another property? They have no idea. And until they do, your entire loan is on hold. Every single dollar for your down payment and closing costs must be sourced and seasoned. Source means they know exactly where it came from. Season means it's been sitting in your account for a while, typically at least 60 days. That $20,000 gift? It needs a paper trail. You'll need to provide a gift letter, a signed document from your parents stating the money is a true gift and not a loan. You'll also need a copy of the check itself and proof that the funds have been transferred from their account to yours. Feels invasive. It feels like you're being treated like a criminal. But remember the detective, they have to follow the money and close every loop. The same goes for selling a car for cash or pulling money out from under your mattress. If you can't prove where the money came from, as far as the lender is concerned, it doesn't exist. Job changes are another landmine. You might get a promotion with a huge raise halfway through the process. Fantastic news. But if your pay structure changes from a stable salary to being heavily commission-based, the underwriter might hit the brakes. They typically need to see a 2-year history of you earning that type of variable income before they can count it. Your amazing promotion could actually jeopardize your loan if it's not handled correctly. Finally, we have the third path. This one isn't about you at all. The underwriter has scrutinized your past and your present. Now they must investigate the future. And the future is the house itself. This is the path of collateral. The bank is lending you money, but the loan is secured by the property. If you stop making payments, they take the house. So they need to be absolutely certain that the house is worth what you're paying for it. The key to this path is one of the most nerve-wracking documents in the entire process, the appraisal. The lender hires an independent, third-party appraiser to give their professional opinion of the home's market value. This appraiser researches recent sales of similar homes in the area, known as comps, inspects the property's condition, notes its features, and comes up with a number. And the entire deal hinges on that number. This is where dream homes become nightmares. Let's say you've agreed to buy a house for $400,000. You love it. It's perfect. But the appraisal comes back at only $380,000. The lender will only finance the loan based on the lower of the two values, the sale price or the appraised value. They will not lend you money for a house that isn't worth it. You now have a $20,000 gap. You have a few options, none of them easy. You can try to negotiate with the seller to lower the price. You can try to dispute the appraisal, which is a difficult uphill battle. Or you can come up with the extra $20,000 in cash out of your own pocket. If you can't do any of those things, the deal is dead. Your appraisal contingency in the contract is your escape hatch, allowing you to walk away and get your earnest money back. But value isn't the only thing the appraiser looks for. They are also the lender's eyes and ears on the ground, checking for health and safety issues. They'll note a leaky roof, evidence of termites, a non-functional heating system, or broken windows. If the appraiser flags these problems, the lender will often require the repairs to be completed before they will fund the loan. This sets off a frantic new round of negotiations. Who will pay for the new roof? The buyer? The seller? This single report can send everyone scrambling, threatening to derail the closing timeline just as you're nearing the finish line. Credit, capacity, collateral. your past, your present, and your future investment. The underwriter puts all three under a microscope. Their initial review results in what's called a conditional approval. It's a huge milestone. It means they've reviewed the big picture and they're on board if you can satisfy their list of conditions. These conditions are the final hurdles. They might be simple like an updated pay stub, or they might be complex like sourcing that mystery deposit or proving a repair has been made to the home. As you and your loan officer work to clear these conditions, you're chipping away at the final wall between you and the keys to your house. Once every single condition has been met, every box checked, and every question answered to the underwriter's satisfaction, they issue the three most beautiful words in the entire home buying journey. Clear to close. Those are the words. That's the signal from the lender to everyone involved, to you, to your agent, to the seller, to the title company, that the loan is officially 100% approved. The underwriter has signed off. The money is ready. The finish line, which for weeks has felt like a mirage in the desert, is now real, solid, and directly in front of you. Your file moves from the underwriting department to the closing department, and a flurry of final activity begins. This is the moment the fog of war lifts. All the back and forth, the requests for documents, the waiting, it's over. But this is not the time to relax. This is the time for precision. Think of it like a space mission. You've successfully launched the rocket, you've broken through the atmosphere, and you've navigated through the asteroid field of underwriting. Now, you're preparing for the final landing sequence, and every single calculation has to be perfect. The first, and arguably most important, part of this landing sequence is the arrival of a document called the Closing Disclosure, or the CD. If the loan estimate was the flight plan, the closing disclosure is the final mission telemetry, showing every single real, finalized number down to the penny. This document is so critical that the federal government stepped in and created a law around it. It's part of the know before you a rule, and it mandates that you, the borrower, must receive your closing disclosure at least 3 full business days before your scheduled closing date. Let me repeat that because it is a non-negotiable, ironclad rule. You must have this document in your hands a minimum of 3 business days before you are allowed to sign the final loan papers. This isn't a guideline, it's federal law. You cannot waive it. You can't say, "Oh, I'm in a hurry, I'll just look at it at the closing table." It's not allowed. This 3-day period is your legally protected time to review, question, and understand every single dollar you are about to commit to. When that CD hits your inbox, drop everything. This is your financial Bible for the biggest purchase of your life. Open it up, and the very first thing you should do is pull up that loan estimate you received weeks ago. You're going to compare them side by side. Your mission is to make sure the final story matches the one you were told at the beginning. Page 1 of the closing disclosure is a masterclass in clarity. It gives you the executive summary. Right there at the top, you'll see your loan amount, your interest rate, and your monthly principal and interest payment. Does that interest rate match what you locked in? It absolutely should. Then you'll see a section for projected payments, which will include your property taxes and homeowner's insurance, that full pity payment we've talked about. Finally, on page 1, you'll see 2 of the most important numbers in the whole process: the closing costs and the cash to close. Now flip to page 2. This is the nitty-gritty, the itemized receipt for your home purchase. It breaks down all those closing costs. You'll see the loan costs, things like the origination fee, the appraisal fee, the credit report fee. Then you'll see the other costs, the title insurance fees, the recording fees for the county, and any inspection fees you chose to roll in. Here's the key: certain fees, like the lender's origination charge, legally cannot increase at all from your loan estimate to your closing disclosure. Other fees, like the cost of a third-party appraiser or title company, have a 10% tolerance, meaning they can't go up by more than 10%. And some fees, like your prepaid homeowner's insurance or property taxes, can change because they depend on the provider you choose and the exact day you close. Your job is to scan this page and look for any red flags, any fee that seems out of place or dramatically different from what you were quoted. Page 3 continues this breakdown and then presents a final summary. It shows the total amount you're paying, the total amount the seller is paying, and then it calculates the magic number, your final official to the penny cash to close amount. This is the exact amount of money you need to bring to the closing table. This number is the culmination of your down payment, plus all your closing costs, minus your earnest money deposit, and minus any credits you're receiving from the seller. This is it, the big one. If you see anything, and I mean anything, on this closing disclosure that you don't understand or that doesn't look right, you pick up the phone immediately and call your loan officer. That is what the 3-day review period is for. It's for asking questions. It's for getting clarity. It's for making sure there are absolutely zero surprises when you sit down to sign. Once you've reviewed and approved the CD, the final pieces of the puzzle start locking into place with breathtaking speed. The first is bringing your money. That cash-to-close figure isn't just a number on a page. It's the amount of money you need to transfer to the title company or closing attorney. And you don't bring this in a briefcase full of cash. For security and verification, this will almost always be handled via a wire transfer or, for smaller amounts, a cashier's check. And this brings me to one of the most important warnings I will give you in this entire series. Beware of wire fraud. This is a massive, devastating scam that has cost homebuyers their entire life savings. Here's how it works. Scammers hack into the email accounts of real estate agents or title companies. They monitor the transaction, and right before closing, they will send you an email that looks perfectly legitimate. It will have the title company's logo, the correct property address, and all the right details. But it will contain fake wiring instructions, directing your money into their fraudulent account. Once you send that wire, the money is gone, instantly, and it is virtually impossible to get back. So, how do you protect yourself? It's simple, but you must be disciplined. You will never ever trust wiring instructions that you receive in an email. Period. When it's time to wire your funds, you will find the phone number for the title company from an independent source, either from the original contract you signed or by looking them up online. You will call that number, get a live person on the phone, and you will verbally confirm the wiring instructions, the account number and the routing number, before you initiate the transfer. Do not call a number listed in a suspicious email. Do not reply to the email to confirm. You must make an outbound call to a known trusted number. This one phone call could save you from financial ruin. While you're arranging the wire, two other crucial things are happening. First, you'll need to pay for your first year's homeowner's insurance premium. You already got the insurance binder for the underwriter, but now you need to activate the policy by paying for it in full. You'll send proof of this payment to your lender and the title company. Second, and this is your last chance to protect yourself, is the final walkthrough. This is usually scheduled 24 to 48 hours before closing. This is not a home inspection. That's already done. The final walkthrough has one purpose: to verify that the property is in the same condition it was in when you agreed to buy it. You're checking to make sure the sellers have moved out completely, that no new damage has occurred during the move out, and that any repairs they agreed to make have been completed satisfactorily. Turn on every light switch, run every faucet, flush every toilet, test the heat and the AC, run the garbage disposal, open and close the garage door, check the walls for any new holes or scrapes, make sure the appliances that were supposed to stay are still there and are working. If you get to the walkthrough and discover the sellers took the refrigerator they were supposed to leave, or that their movers punched a hole in the drywall, you do not proceed to closing until it is resolved. Once you sign those papers, any problems you discover are your problems. The final walkthrough is your last line of defense. So you've reviewed the closing disclosure. You've triple-checked the wiring instructions and sent your funds. You've paid for your insurance. You've completed the final walkthrough and the house is perfect. The title company has confirmed receipt of your money, and they've confirmed receipt of the lender's money. All the documents are prepared. The appointment is set. You're holding your driver's license and your checkbook, just in case of any tiny last-minute adjustments. Your heart is pounding. You take a deep breath. It's time to go to the closing table. It's time to sign your name, over and over again, on a stack of papers that will fundamentally change your life forever. You walk into a conference room. The air is thick with a strange mix of nervous energy and the faint smell of toner from a copy machine working overtime. Sitting at a long, polished table are the final characters in your home buying saga. Your real estate agent, maybe the seller's agent, and a person you've likely never met before, the closing agent or title officer. They are the master of ceremonies for this final act, and in front of your chair it sits, a stack of paper so thick it looks like the manuscript for a novel. A novel about you, a house, and a very large amount of money. This is the moment of truth. Your first instinct might be panic, a primal urge to just sign wherever they point, get it over with, and grab the keys. But this is the final exam, and you've studied for this. You are prepared. Let's break down this mountain of paper into what really matters. You are not just signing your name. You are signing 3 monumental agreements that will shape your financial future. Think of them as the holy trinity of closing documents. The first one you'll look at should feel familiar. It's the final closing disclosure, or CD. We talked about the one you received 3 days ago. This is its identical twin, the one that goes on the permanent record. Your mission here is simple but critical. Play a quick game of spot the difference. Pull out the copy you reviewed earlier and place it side by side with the one on the table. Do the numbers match? Is the interest rate the same? Are the closing costs exactly what you expected? Are the credits from the seller correct? 99 times out of 100, everything will be perfect. But you are your own best advocate. And this is your last chance to catch a typo or a mistake before it's literally set in stone. Don't be afraid to take a minute. Ask the closing agent, "Can you just walk me through these final figures one more time?" It's your money. You have every right to be absolutely certain. Once you're confident the numbers are right, you'll encounter the second, and arguably the most important, document in the entire stack: the promissory note. This document is deceptively simple. It's usually just a few pages long. But don't let its size fool you. This is the IOU. This is your personal, legally binding promise to the lender that you will pay back every single penny of the money they are giving you, plus interest. This document is the beating heart of the loan itself. It has nothing to do with the house. In fact, if you were to read it carefully, you'd see the address of the property is mentioned, but the core of the document is about the debt. It's a contract between you and the lender. It will state, in no uncertain terms, the total amount of money you borrowed, the interest rate you'll be paying, the date your payments start and when they're due each month, the breakdown of your principal and interest payments, and, critically, the consequences if you fail to pay. This is the document that makes you personally liable for the mortgage debt. It's the one that says, "I promise to pay." When you sign this, you are forging a direct, personal financial commitment that will last for the next 15, 20, or 30 years. It's a profound moment. You're not just signing a piece of paper. You're signing a promise to your future self. Now, you might be thinking, okay, so the note is my promise to pay. But what stops me from just walking away from that promise and the house? That's where the third member of our trinity comes in: the mortgage, or in many states, the deed of trust. If the promissory note is the IOU, the deed of trust is the collateral. It's the or else. This is the document that connects your promise to the actual physical property. It's the legal instrument that gives the lender a security interest in your new home. In plain English, this document says, "I have promised to pay back this loan, as detailed in the promissory note. To guarantee that promise, I am putting this house up as collateral. If I break my promise and stop paying, the lender has the legal right to take possession of this house through a process called foreclosure to get their money back." This is the document that gets publicly recorded, telling the entire world that while you are the owner of this home, there is a lender with a primary claim to it until the loan is paid in full. It's the lender's ultimate insurance policy. It's what makes a mortgage a secured debt. The promissory note secures the debt to you. The deed of trust secures the debt to the house. Understanding this distinction is crucial. You're making two separate but deeply intertwined commitments. After you've reviewed and signed these three titans of paperwork, the rest of the stack will feel less intimidating. You'll sign documents acknowledging you understand your escrow account for taxes and insurance. You'll sign disclosures about flood zones, lead paint, and local ordinances. You'll sign tax forms. You'll sign your name so many times your hand will start to cramp. You'll initial pages until the letters J and D lose all meaning. Feels repetitive, almost ceremonial. And in a way it is. Each signature is another small step, another confirmation, solidifying your transition from home buyer to homeowner. While you're doing this, a flurry of activity is happening behind the scenes. The closing agent is coordinating with your lender. Your lender is giving the final all clear to release the loan funds. That giant cashier's check you brought for your down payment and closing costs is being processed. Wires are flying across the digital ether. It's a carefully choreographed financial ballet. And your signature is the final crescendo. And then it stops. The closing agent will gather up the signed documents, making neat piles. They'll make a few copies. There might be a moment of quiet chatter as they finalize their own paperwork. You'll look at your agent, who will probably be smiling. The tension in the room, once so thick you could feel it, has evaporated. Then the closing agent looks up at you. They slide something small and metallic across the polished table. It makes a soft clinking sound. Keys. A house key. A mailbox key. Maybe a key for the garage. They feel impossibly light in your hand for what they represent. They are not just pieces of metal. They are the physical manifestation of months of searching, saving, stressing, and signing. They are the culmination of every decision you've made on this journey. They are the symbol of your new beginning. You did it. You survived the paperwork. You faced the final boss. You conquered the closing table. You hold in your hand the very keys to your future. You walk out of that office not as a hopeful buyer but as a homeowner. The feeling is surreal, a mixture of exhaustion, relief, and pure unadulterated joy. You get in your car and you drive, not back to your old apartment or your parents' house but to your house. Your home. But as you pull up to the curb and look at that front door, a new thought begins to dawn. The journey to get the keys is over. But the journey of homeownership is just beginning. What do you do now? In the first 24 hours? The first week? The first month? There are a few critical first steps every new homeowner needs to take immediately after closing, and that's exactly what we're going to cover next. The keys are in your hand. The ink is dry. You've conquered the mountain of paperwork, navigated the inspections, and survived the underwriting gauntlet. But as you stand on the doorstep of your new property, that feeling of triumph is quickly followed by a new, slightly terrifying question. Now what? The truth is, closing isn't the finish line. It's the starting line. And the first few steps you take as a homeowner are some of the most critical for setting yourself up for success and peace of mind. Before you even think about unpacking a single box, your absolute first priority is security. That shiny key in your hand? So did the seller, the seller's agent, the buyer's agent, maybe a contractor or a cleaner? You have no idea how many copies of that key are floating around town. So your very first call, before you even order a celebratory pizza, should be to a locksmith. Get all the exterior locks rekeyed or replaced. This isn't paranoia. It's basic, non-negotiable security for your family and your biggest asset. It's the move that officially makes the home yours and yours alone. While you're waiting for the locksmith, go on a treasure hunt. You need to find 3 critical things: your main water shutoff valve, your gas shutoff valve if you have one, and your electrical circuit breaker box. A pipe doesn't wait for a convenient time to burst. It happens at 3 a.m. on a holiday weekend. Knowing exactly where to go to shut off the water in a panic can be the difference between a small puddle and a catastrophic flood that costs tens of thousands of dollars to repair. Take a video on your phone of where they are and how to turn them off. Label the breakers in the box if they aren't already. This 5-minute task is one of the highest return investments of time you will ever make as a homeowner. Next, in these first 24 hours, handle your utilities. You should have already scheduled the transfer of services like electricity, water, gas, and trash for your closing date. But now you need to verify it. Go take a picture of your electric and water meters. This creates a time-stamped record of the readings on the day you took possession. Utility companies can and do make billing mistakes, and having this photo can save you from paying for the previous owner's last month of usage. This is also when you schedule your internet installation. Pro tip: do this weeks in advance if you can. Installation appointments can be booked out, and you don't want to be stuck using your phone's hotspot for 2 weeks while trying to work from home. Now we move into the first week. Before the moving truck arrives with all your furniture, this is your one and only golden opportunity to do a deep, forensic clean. The previous owners may have tidied up, but their version of clean and your version of clean are probably very different. Clean the places you'll never be able to reach again once your stuff is in the way. Inside all the cabinets and drawers, behind the refrigerator and stove, the tops of ceiling fans, the baseboards. Shampoo the carpets. This isn't just about hygiene. It's about resetting the space. It's a ritual that washes away the old and prepares the home for your new life within its walls. While you're cleaning, your next task is to become the master of your mail. Immediately go to the U.S. Postal Service website and file an official change of address. This is crucial, but it's only the beginning. The Postal Service Forward is a temporary safety net, not a permanent solution. You need to start updating your address directly with every single entity that matters. Your banks, credit card companies, your employer's HR department, your car insurance, health insurance, any subscription services, your Amazon account, your voter registration. Make a master list and check them off one by one. You don't want your new credit card or a sensitive medical bill accidentally ending up in your old mailbox. And here's a step people often neglect in the chaos of moving. Go meet your neighbors. You don't need to bake a pie, just take a walk. When you see someone outside, go introduce yourself. Hi, we're the new owners at 123 Maple Street. Just wanted to say hello. These are the people who will notice if a strange car is parked in your driveway while you're on vacation. They're the ones you might need to borrow a ladder from. They can tell you which day the recycling actually gets picked up. Building a little goodwill with the people on your street is an investment in your community and your own quality of life. Now let's zoom out to the first month. This is where you establish the habits and systems of a responsible homeowner. First and foremost, your mortgage. You'll soon receive a flood of mail. Among the junk, you'll get your first mortgage statement or a letter from your loan servicer, the company you'll actually be paying. It might not be the same company as your original lender. Read this document carefully. It will have your loan number and instructions on how to set up your online payment portal. Do this immediately. Set up autopay. The last thing you want is to start your homeownership journey with a late payment because a letter got lost in the mail. A single late payment can ding your credit score and cost you a hefty fee. Get it set up, automate it, and forget about it. Next, you're going to create something I call the Home Bible. Get a simple 3-ring binder. This will become the official owner's manual for your house. In it, you'll keep a copy of your closing statement, your inspection report, and your home warranty documents. Create tabs for each major system: HVAC, plumbing, electrical, appliances. When you have the furnace serviced, put the receipt and the technician's business card in the HVAC section. When you buy a new dishwasher, put the manual and warranty in the appliances section. Record the paint colors you use for each room. This binder is invaluable. When something breaks, you'll know exactly who to call. And when you eventually sell the house years from now, handing this organized, detailed binder to the new owners is a massive sign of a well-maintained home, adding real value. Finally, and this might be the most important piece of advice in this entire series, start a dedicated home repair fund. I'm not talking about your regular 6-month emergency fund. This is a separate savings account, a when-not-if fund, because the water heater will fail, the air conditioner will die on the hottest day of the year, the roof will eventually leak. These are not emergencies. They are predictable, eventual costs of owning a physical structure. Start feeding this account automatically every single month, even if it's just $50 or $100 to start. A good rule of thumb is to aim to save 1% of your home's value per year for maintenance. So for a $400,000 house, that's $4,000 a year, or about $333 a month. Having this cash set aside turns a potential financial catastrophe into a mere inconvenience. It's the single best thing you can do to protect your investment and eliminate a massive source of homeowner stress. And that's it. You've done it. From the first spark of an idea to saving for a down payment, getting pre-approved, hunting for houses, making an offer, surviving underwriting, and getting through closing, you are now officially a homeowner. You've learned the language of loans, the dance of negotiations, and the discipline of diligence. You've taken one of the biggest steps of your life. This house is more than just a collection of wood, drywall, and wires. It's the backdrop for your future. It's where memories will be made, where you'll find comfort after a long day, and where you'll build a cornerstone of your financial future. The journey was long, but everything you learned along the way has prepared you for this moment, and for all the moments to come. You didn't just buy a house, you earned it. If this series helped you on that journey, if it demystified even one part of this complex process, then do us one small favor. Share it. Send it to one friend, one family member, one coworker who is dreaming of their own first home. Because knowledge is the key that unlocks the door, and you now hold that key. Welcome home.